Welcome back to CPA Mastery. In Lesson 1, we introduced the concept of gross income and built the basic mindset that the IRS generally treats economic benefits as taxable unless the tax code specifically says otherwise. In this lesson, we're narrowing our focus to one of the most common categories of gross income on the CPA exam: compensation for services. We'll look at wages, salaries, bonuses, commissions, and tips, and then we'll move into fringe benefits, which are employer-provided perks that can either be taxable or excluded depending on the rule. This is an important lesson because compensation issues show up constantly in reg questions. If you can tell the difference between ordinary taxable pay and excluded fringe benefits, you'll be able to calculate gross income much more accurately and avoid some very common exam mistakes. In this lesson, we have 4 goals. First, we want to define compensation income and understand why it is usually included in gross income. Second, we want to identify the most common forms of compensation that show up on the CPA exam, including wages, salaries, bonuses, commissions, and tips. Third, we want to understand fringe benefits. Employers do not always pay workers only in cash. Sometimes they provide additional perks, and those perks can raise tax issues. Finally, we want to build an exam process that helps you decide whether a payment or benefit should be included in gross income. If you can identify the service performed, the economic benefit received, and any available exclusion, you'll be in a strong position on reg questions. Compensation income refers to payments a taxpayer receives in exchange for performing services. This is the most common type of income individuals report on their tax returns, and it is one of the most frequently tested areas in the reg section. A helpful way to think about compensation is this: if the taxpayer worked and got paid for that work, the payment is usually compensation income. That payment might be cash, but it could also be another item of value connected to the employment relationship. For the CPA exam, the default assumption should be that compensation is taxable. Do not start by looking for reasons to exclude it. Start by assuming it belongs in gross income, and then look to see whether the tax code provides a specific exclusion. Employees can receive compensation in several different forms. Wages and salaries are the most familiar, but compensation also includes bonuses, commissions, tips, and other incentive-based payments. For example, an employee might earn a fixed annual salary and then receive an additional bonus at year-end. A salesperson might earn commissions based on revenue generated. A restaurant server might earn tip income from customers. For tax purposes, these are all forms of compensation for services. The CPA exam often mixes these items together in one fact pattern. Do not overcomplicate that. If the amounts represent payment for work performed, they generally get combined and included in gross income unless the question clearly identifies an exclusion. In addition to ordinary cash compensation, employers often provide workers with fringe benefits. A fringe benefit is an additional perk or advantage provided as part of the employment relationship. Examples include employer-provided health insurance, use of a company vehicle, educational assistance, or employee discounts. From a tax perspective, the key question is whether the employee received an economic benefit that should be included in gross income. This is where students often get tripped up. Some fringe benefits are clearly taxable, but many common benefits are excluded under specific provisions of the tax code. So when you see a fringe benefit on the CPA exam, do not assume all benefits are treated the same way. The tax result depends on the specific type of benefit involved. Some fringe benefits clearly increase an employee's personal wealth and therefore must be treated as taxable compensation. A good example is personal use of a company car. If an employee uses the employer's vehicle for non-business purposes, the value of that personal use may be included in income. Cash allowances are another common example. If the employer gives the employee money rather than a specifically excluded benefit, that amount is usually taxable. The same idea applies when the employer pays the employee's personal expenses. For exam purposes, a useful shortcut is this: if the benefit looks like a direct personal economic gain and the question does not mention an exclusion, it probably belongs in gross income. Not all fringe benefits are taxable. In fact, the tax code specifically excludes several common employer benefits from income. One of the most important examples is employer-provided health insurance. When an employer pays for an employee's health coverage, that benefit is generally not included in the employee's taxable income. Educational assistance may also be excluded in some situations, depending on the facts and the applicable rules. Another key category is de minimis benefits. These are small perks that are so minor in value that the IRS does not require them to be taxed. Think of occasional snacks, coffee, or other very small workplace conveniences. On the CPA exam, these exclusions matter because they keep you from overstating gross income. This slide highlights a point that reg questions test often. Not all compensation comes in the form of regular payroll. Bonuses, commissions, and tips are still compensation income, even if they are calculated differently from salary or hourly wages. A performance bonus paid at year-end is taxable compensation. A commission paid to a salesperson is taxable compensation. Tip income earned by a server or similar worker is also taxable compensation, even though the money may come from customers rather than directly from the employer. Students sometimes mentally separate these items from wages, but that is a mistake. For tax purposes, they are all payments connected to services, so they usually belong in gross income. Employer-provided health insurance is one of the most important fringe benefit exclusions to remember. It clearly provides value to the employee because the employer is paying for coverage the employee would otherwise have to purchase. But despite that value, the tax code generally excludes the cost of employer-provided health insurance from the employee's gross income. That means the benefit exists, but it does not increase taxable income in the usual way. This is a great reminder that tax law does not simply ask whether something has value. It also asks whether Congress created a rule that excludes it. On the CPA exam, health insurance is one of the safest examples of an excluded fringe benefit. Let's work through a simple compensation example. Suppose a taxpayer earns a $75,000 salary during the year. In addition, the taxpayer receives an $8,000 performance bonus and $4,000 of commission income. All three amounts represent compensation for services. None of them qualifies for a specific exclusion, so all of them must be included in gross income. When we add the salary, bonus, and commission together, the taxpayer's total compensation income equals $87,000. The CPA exam often tests this exact kind of aggregation. The challenge is usually not the math. The challenge is recognizing which items belong in the calculation in the first place. Now let's look at a fringe benefit example. Suppose an employer pays $5,000 toward an employee's health insurance coverage during the year. That payment clearly benefits the employee, so from a pure economic perspective it has value. But tax law does not stop at value alone. The next question is whether the tax code excludes that benefit from income. In this case, employer-provided health insurance is generally excluded. So even though the employee received something valuable, the $5,000 is not added to gross income. This is exactly the kind of distinction the reg exam wants you to make. Identify the benefit, then ask whether an exclusion applies. Here's the big trap for this lesson. Students often hear that compensation is broadly taxable and then overapply that idea to every employer-provided benefit. That leads them to include items in gross income that should actually be excluded. Employer-provided health insurance is a perfect example. It has value, but it is generally excluded. De minimis benefits are another example. So the mistake is not forgetting that benefits can be taxable. The mistake is assuming they are always taxable. On exam day, slow down and classify the benefit. Ask what the employer provided, whether it gave the employee an economic benefit, and whether the tax code specifically excludes that type of benefit from income. Here's the exam process I want you to use for compensation questions. Step 1. Identify exactly what the taxpayer received. Was it salary, a bonus, a commission, a tip, or a fringe benefit? Step 2. Ask whether the item was received in exchange for services. If the answer is yes, the starting assumption is that it belongs in gross income. Step 3. Check whether the item is a fringe benefit that qualifies for a specific exclusion. This process keeps you from jumping to conclusions too quickly. It also helps you separate ordinary taxable compensation from excluded employee benefits, which is one of the most important distinctions in this lesson. Let's wrap up the lesson. Compensation income generally includes wages, salaries, bonuses, commissions, tips, and other payments received in exchange for services. These items are usually taxable and belong in gross income. Fringe benefits add another layer because some are taxable while others are excluded under specific rules. Employer-provided health insurance is one of the most important exclusions to remember. Most importantly, keep using a consistent exam method. Identify what the taxpayer received, decide whether it was connected to services, and then check for any exclusion. That process will help you answer compensation questions with much more confidence.